Meet the Seavers. They're your average family planning for their future and their future medical expenses. They have a health savings account, also called an HSA, that allows them to save money on their current and future healthcare expenses. For the Seavers, taking advantage of the HSA Triple Tax Advantage is an important part of their savings and investment planning. Their contributions, interest, investment earnings, and the use of funds for qualified healthcare expenses are tax-free. You see, if Sally and Steve's saving and spending rates are relatively consistent over the next 20 years, the balance in their HSA can be used to pay for medical expense during their retirement. By using a HSA balance and tax savings calculator, the Seavers can see how their savings can add up over the next 20 years. Here's what the Seavers entered into the calculator. Estimated HSA contributions of $4,000 per year going into their account. They also figured their combined annual medical expenses to be paid using their HSA savings account would be $2,000. Then, they assumed their federal income tax rate, or bracket, would be at 25%, and their state income tax rate would be 0%. Finally, they put in an average annual interest rate of return of 2.5%. Now, before we do the math on what the Seavers were able to keep for their retirement, let's take a look at why the HSA makes so much sense for saving. We know that over 20 years, the Seavers were able to put away a total of $80,000 into their HSA before any expenses were taken out. Let's just suppose that they didn't use their HSA and used a regular old bank account that is subject to regular income tax rates of 25%. Because they paid $1,000 in taxes each year, they lose $20,000 by not making use of the tax-free HSA. So putting regular contributions into an HSA protects your money from the tax man. So every dollar that